today we're going to talk about the most recent CPI report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. Inflation came in at 3.1%, which is it's a better number than last month. So last month it came in just a bit hotter. You can see if we zoom in, we've fallen headline inflation, a couple of tenths there, down to 3.1% or so, which is at least a move in the right direction. But the expectations were that it would move down to 2.9%. So it did certainly come in hotter than expected. And then core inflation came in about the same as where it was last month. The headline number, the main number they're reporting for core CPI is of course 3.9. You can see last month it was at 3.91. This month it came in at 3.87. So core CPI remained relatively unchanged, and the expectation was that it was going to go down to 3.7%. So inflation remains sticky. And we've talked a lot before about how, making that last jump from 3% to 2% is going to prove tricky, and it's going to be the hardest percent to achieve. I mean, going from 9 to 8 or 8 to 7 isn't nearly as difficult to go from that 3% number down to that 2% number. And look, I mean, so far, the Fed's job has been relatively straightforward, and that's to raise rates and to keep rates elevated. And, I think that they haven't really had much of a choice in the matter, especially after the whole, inflation is transitory dilemma. But now that we are getting further and further into the business cycle, at some point, you would have to imagine there's going to be some trade-offs, right? The labor market has remained relatively strong, throughout the entire business, throughout the entire hiking cycle. And that's why I say it's left the Fed with very little choice, and that's to raise rates and to keep them higher for longer. But as long as inflation remains at 3% and without really showing a durable move to 2%, you have to wonder, what is the likelihood that the Fed is going to cut as soon as the market thinks? And the market's constantly changing what they think. Just a few months ago, the market thought they were going to cut in March. Then they thought they were going to cut in May. And now it looks like the market thinks they're not going to cut until June. Right? So the timeline on these nebulous rate cuts, it just simply gets continued to be, it's pushed further and further out every time we get this data. And if you think about what Powell was saying, he said that they don't think they're going to have enough data between the January meeting and the March meeting to warrant a rate cut. I mean, he basically came out and said that, which was telling, considering he normally doesn't like to advertise what they're going to do. But he was pretty convinced himself, it sounded like, that there's not going to be enough progress made on inflation between January and the March meeting. And certainly this most recent print has, solidified that case, that there's no guarantee that inflation is going durably back to their target, especially if they were to pivot now. If you go back to the 1970s, and Powell has referenced this many times, if you pivot too soon, you run the risk of getting another wave of inflation. And I'm sure you've seen all the charts posted to Twitter or X where people are sort of overlaying the 1970s to the current day and showing that, look, if we're to repeat what happened back then we run the risk of another wave of inflation. And of course, that's true. I mean, if the Fed were to pivot too quickly, then it could, it could lead to the economy reaccelerating even more and leading to a second round of inflation. I mean, you can kind of imagine what happened over here, right? Inflation started to come back down. The Fed got, somewhat optimistic, pivoted too quickly, and then we just got another round of inflation. And the same thing just kept happening over and over and over again until finally Volcker came in and raised rates well above, I imagine, what most people were expecting, and then ultimately durably brought inflation back down to their 2% target, and they even overshot it all the way down to 1% or so. But it took a lot. I mean, it took, and I think that was when they finally realized what it was going to take to get it there. I think before, if you were to go take a look at let me just overlay interest rates, this is the S&P 500 overlaid with interest rates. Like if you were to go back to the 1970s, and you can just see like, all the rate hikes and pivots in here, right? And then I think finally they were just like, all right, well, to hell with this. We're just going to raise rates until inflation really is, durably back to target, and then we'll finally lower rates. And you can see that's exactly what they did, right? I mean, they pivoted too quickly, and then they had to raise rates again. And Powell has said that they want to avoid that scenario, right? They want to avoid the scenario where they cut and then a few months go by, and then you see the economy start to reaccelerate, you see inflation start to go back up, and then you run the risk of then having to go to a higher rate. Powell has said that 5.5% is likely the terminal rate. That was my expectation, almost 2 years ago, was that 5.5% would be the terminal rate for this business cycle. But if they were to pivot too soon, and let's say go back down as like 4% or something, and if inflation were to reaccelerate, then they might have to go up, to an even higher interest rate, right? Like to 6% or something. And I imagine they want in say like a futures business cycle. I imagine they would like to avoid that, but I guess we're going to find out if the Fed really means what they say, and if they will keep rates high enough until inflation is durably going back to target. And right now, I don't think anyone can look at this data and definitively say that inflation's going back to target. It could be, right? I mean, there's a chance that if they were to pivot now, that it could go back to target, but we don't know, right? Like, I mean, there's not any clear path here that shows that it's going back to 2%. And again, going back to the 1970s, we can see periods where it got down to 3% or even 5% and then just reaccelerated. So that is something I think we have to keep in mind. Now, if you were to look at per category, right? So this is per category. We're going to go through all of them. So here's headline. Okay, it came down really quickly down to 3%, but then it's basically been at 3% since June of 2023. Hasn't really moved. Food and beverages continues to go down, right? So it was at 2.72. Now it's at 2.55%. So it continues to come down. I got to remind people. I wish I didn't have to remind people of this, but, there's even like leaders that say this sort of stuff. And I'm like, how can you not know this? It's just because inflation is coming down does not mean that prices are coming down. Okay, we have to remember that if if food and beverage inflation is 2.55%, right? That doesn't mean food prices are going down. It just means they're going up less quickly. Okay, it means they're going up 2% a year instead of what we were getting, which was around 10 to 11% a year. So try not to mistake disinflation with deflation, right? Disinflation is just where the rate of change of inflation, it's still above zero, right? It's still above zero, but you still have some level of inflation. There are some categories that have experienced deflation, meaning it's gone below zero and prices have theoretically come down, although a lot of people would dispute that. Housing is not one of them. Housing remains relatively elevated, continues to move in the direction that you might expect. Right now, it dropped from 4.83% down to 4.66%, but it's still going relatively slowly. And of course, this is one of the major contributors to CPI. Apparel is something that is now basically back to zero. I mean, you can see that last month it was at 1.38%. Before that, it was at 2.71%. So this one has come all the way back down to zero. So what you have is you have some categories that are really elevated, like housing in terms of inflation, but other categories seem like they're already back to target. Now, some people might make the case that if the Fed were to pivot now, the other categories would eventually make it to target. But I think the issue is that while you may be true about that assertion, I don't think that the Fed is willing to take that risk, right? You might be willing to take that risk, but I don't think the Fed is willing to take that risk, and that's why I think they will, they'll likely not cut in March. Transportation is one that went deflationary. not too long ago, but now it's back to being inflationary by about 2% or so. But transportation is something that has often gone deflationary. It tends to be a little bit more volatile than some of the other data series. Medical care also theoretically went deflationary, although I know a lot of people would dispute that. I'm not going to argue with you. I'm just looking at the data. Back up to 1%, right? So some of these that were deflationary and were helping to detract from CPI have now started to contribute again to it. So while you do have things like housing going down still, you have things that were deflationary now becoming inflationary again, like transportation and medical care. Recreation was probably one of the bigger store points of this report because it went back up, right? It has been moving down, but it found at least a local bottom in November at 2.49%. Then it went to 2.71% in December, and then back up to 2.77% in January. So this is a metric that continues to go in the wrong direction. And that's 2 months in a row now, which I'm sure the Fed's not going to be happy to see. Education and communication was deflationary a couple of months ago, a month or two ago. Now it's back to being slightly inflationary, but still near 0%. And then finally, other goods and services has remained sticky as well and has gone up from 5.55% to 5.7%. And this has been one of the stickier series that we've had. I mean, you can see that we haven't really made a ton of progress. I mean, we've moved up from a high of 7.02% to 5.7%. Not a lot of change in the grand scheme. I mean, think about that. Like the Fed went from basically 0% rates to 5.5%, and other goods and services inflation has only dropped from 7% or so to 5.7%. So not a lot of progress there. So if you're looking at this, right, if you're looking at these categories, whether you're looking at headline inflation, whether you're looking at core inflation, whatever it is you're looking at, I don't think you can look at it and say that the Fed needs to cut. Again, I'm not saying that that's necessarily the right choice. There is a path that exists in a theoretical universe where the Fed starts to cut in March and it turns out to have been the right decision because all the other categories are just simply lagging. And while the Fed might cut, 25 basis points or something, it's not going to have a material effect, and it could help the economy when it needs it most. But I don't think the Fed's going to do that. I don't think they're in the business of trying to predict where things are going to go. They're more in the business of reacting to where things do go. And honestly, you can't really blame them if they were going based on what people were predicting. People are predicting all sorts of things for the last 2 years. It didn't come true. So core inflation, still sticky, still near 4%, well above their target of 2%. First rate cut has potentially been pushed out to June. What does that mean as an investor? Well, remember, as an investor, the further you get late business cycle, the further you get, especially as it continues to get extended out, higher risk assets continue to bleed to lower risk assets. And again, if you were to go look at so the S&P is down a little bit today, but the Russell is down 4%. The Russell is actually down 4% today. And you have to wonder, right, why is the Russell down so much? And my argument, and I've said this many times, is that the smaller companies that don't have the luxury of having tens of billions of dollars on their balance sheet because they're newer companies, they just haven't really taken off like some of the bigger ones, they are starved for QE and for lower rates. They need lower rates to really perform well, or they need to at least see some type of normalization where they can expect lower rates in the not so distant future. Remember, markets are forward looking. They don't necessarily wait until something happens to start pricing in that thing happening. So over the last few days, the Russell was moving up, and then look what happened today. It's basically wiped out, 2.5 days of gains in a single day, because one of the reasons here, right, if we were to go up here and look at rate cuts, the rate cut that was potentially going to come in May is now delayed until June. And so it's got to be hard, right, for a lot of smaller companies that were hopefully, are counting on rate cuts to start. And then you have to wonder, like, if you're a company and you're trying to save on expenses and whatnot, you're doing everything you can to potentially not lay people off, which again that would cut costs. You can just lose steam, right? You sort of run out of options, and then you have to start doing things you don't necessarily want to do, like laying people off if the Fed can't cut soon enough. And so we always, each business cycle we run into this dilemma where will the Fed cut soon enough to delay something like that happening? One of the things to look at is when you look at like the Russell against the S&P 500, you can see that it was starting to outperform the S&P for a few days in a row, right? But then today it's given back a lot of that. It's down, the Russell's down 2.3% against the S&P 500 on a day where the S&P is down 1.7% itself. So, this is why I've said before, right? Like the higher risk plays, right? Like the smaller market cap companies, if it's true that rate cuts come soon, then the market likes to run with that and start pricing that in, and you'll see the market sort of go back up. But the minute that those rate cuts get pushed further and further out, those companies like to just give back those gains, right? And that's sort of the risk of the higher risk stuff, is that you just don't know when the pivot is actually going to come. And so what ends up happening is the lower risk stuff continues to outperform, right? Like the NASDAQ and the S&P are only down 2% today, but the Russell is down 4% today. So you can see it pretty clearly with these companies. And one thing to sort of keep in mind, if you were to look at say like the Russell divided by the S&P 500, and you were to overlay, what's a good thing to overlay? Let's overlay bankruptcies. So let's overlay bankruptcies onto this chart. Of course, United States bankruptcies is what I want to look at. So if you do that, I mean, you can see that bankruptcies have really been moving up since about mid-2022, still relatively low given all the history. I mean, like it's not, and this is just going back to where the Russell, but I mean, still relatively low, all things considered, but still moving in the wrong direction, right? Let me pull up the S&P 500 so we can see this chart perhaps a little bit further out. So this purple line here shows bankruptcies, right? So you can see bankruptcies are on the rise, but they're actually still lower than where they were back over here, right? Before the financial crisis. Now, again, they are moving up quickly, and my guess is that they will continue to move up so long as the Fed refuses to pivot, right? Because the companies are still going to say, well, where's the QE? Where are the lower rates? So this is the sort of the conundrum that we're in, is that inflation is sticky, but markets really want looser monetary policy. I mean, you could argue the S&P doesn't really need looser monetary policy. You could argue the NASDAQ, they've been pushing to new highs, right? Do they necessarily need looser monetary policy? Probably not. But smaller market cap stuff does, right? I mean, the Russell hasn't pushed to new highs, and it's continued to struggle here for a long time, and it's been bleeding back to the lower risk companies, which we're more confident can survive the business cycle. Every few weeks, you'll see another company that you might recognize declare bankruptcy or lay people off. And, for a long time, the market ignores it. Remember, the things that we've said before is that the S&P, it loves climbing the wall of worry until it has a reason not to do so. And the two main reasons, other than geopolitical risks, are the reacceleration of inflation or the labor market softening up. So far, inflation hasn't reaccelerated. I mean, it's been flat, right? I mean, I know some people are saying that it's reaccelerating, and I'm not saying it can't turn into that, but at this point, it's still relatively flat, since June of 2023 headline, and core still slowly is moving down. So you have inflation that has not reaccelerated. So that's one risk, has not reaccelerated. So the S&P continues to come to the wall of worry. The other risk, of course, is the unemployment rate, right? Which, by the way, still remains relatively low, right? The unemployment rate is at 3.7%. So again, right now, the Fed has an easy choice. Unemployment rate at secular lows, inflation sticky, you don't cut. What do they do, let's say in May or June, if the unemployment rate is starting to move higher and inflation isn't yet moving lower? That's, I think, sort of a problem that, we'll have to address if it happens. But that I think is going to be a market reaction. There's going to be some type of market reaction there, right? If if the unemployment rate is starting to move higher later this business cycle, but inflation is still not moving lower, and then we'll test the Fed's resolve, right? And then we'll see, do they actually mean what they say, or was it all just words? So far, again, the market has sort of pivoted over to thinking that no rate cuts until June, and I don't know. We'll see if they can. We'll see if they can make it that long. They've already said before they only plan on cutting 3 times this year. So if they cut in June and July, and then the market has them potentially pausing in September and then one in November, it looks like the market is still thinking they'll cut 4 times, going down in December as well. But maybe it's worth considering that the Fed can't pivot that aggressively with inflation where it is today. So just something to consider. And you could also make the same sort of arguments for the altcoin market against Bitcoin, right? And we've talked before about how Bitcoin absorbs more of that market share the further business cycle we get. I still think that's going to be the case. So as an investor, the whole idea is that the lower risk stuff within that asset class outperforms the higher risk stuff within that asset class. And I still think that'll continue to be the case. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. And